This past week, we saw stock prices go down. The last six trading sessions have been down more than 2%. And I expected that because the beginning of the year just really was a very positive beginning, but I knew it wouldn't last. I've organized my thoughts on what I'm going to be doing this coming week with regards to which stocks I'm looking to buy, as well as my additional investments into bonds. I'm an active value investor and I'm looking to buy great companies at a discount, hold them for a long time, and make great returns to beat the S&P index. Let me share with you what I've seen over the last week and what I plan to do over the coming 7 days. Year to date, the S&P index is doing really well, 6.96%. But if you study it carefully, it's gone down 2.14% over the last 6 trading sessions. So it makes sense. We had a very good beginning, but you couldn't go on forever. And I expect that, I don't know that this coming week is going to be a real boom week. I think it's going to be flat or slightly down or slightly higher. Over the past year, the S&P index is down 7.43%. A big part of that is that there's no real big story of why stocks should go up significantly. At this point, we're in a recession or expecting a recession soon. We expect that interest rates will go up higher. We're not seeing any big themes where it's just a boom period. No, it's the opposite. We're hearing layoffs by many different corporations. So there's people being unemployed. So all those stories, I think, are going to keep stocks somewhat limited, and they'll trade sideways, slightly down, slightly up, but I'm not expecting any dramatic increase in the near future. One of the factors that weighs on stocks is rising interest rates. The Federal Reserve is increasing interest rates in order to control inflation, which was really high, and they're doing a good job of it. Inflation is beginning to get down. Now, as we look at interest rates today, they're paying a very good yield, especially on short term. I'm looking at a table here of the Treasury yields from the shortest duration to the longest. And the short-term yields are paying very well. Look at the 6-month, it's almost 5%. 5% return on your money that is essentially risk-free. That's excellent. One theme that's happening is that the yield curve is inverted. What that means is, in most cases, long-term yields are higher than short-term yields, but it's inverted. It's upside down. Right now, short-term yields are far better than long-term yields. And over time, when the Federal Reserve stops increasing interest rates and interest rates are expected to go down, you will see it go back to its natural state, which is shorter term yields would be lower than longer term yields. In all cases where the yield curve on bond yields has been inverted, there was a recession. So just more evidence that we're in a recession, we're headed into a recession, but the long story short is it's unavoidable. A recession is going to be upon us. Looking at the yield on a 10-year treasury, you could see that, 5 years ago, the yield was around 3%, a little under 3%. As we headed into 2019, yields actually dropped. This is before COVID. When COVID hit, the Federal Reserve had to completely drop interest rates to stimulate the economy. They also pumped in all the stimulus dollars. So they took down rates down to almost zero. So you could get a home mortgage at 2.5%. Just financing was very easy in these periods. But you could see that in a very short period of time, within a year and a half, it has gone up more than 3% on the Treasury. And what that ended up doing was doubling of mortgage rates, if not more. Auto loans have gone up significantly. And the discount rates that we use when we value a stock, the discount rate, the weighted average cost of capital, has more than doubled. That has an adverse effect on the valuation of a company. So this, interest rates have a very fundamental effect on stocks. And that's why I study them and understand where are rates going. If they're going to go up higher, I expect stock prices are going to go down. If interest rates are going to go lower, the opposite, stock prices are going to run free. Let me show you an example of the S&P index here in purple compared to the same graph I was showing. You can see that as interest rates have gone up, the S&P index has come down. And more recently, you can see that that interest rate rise that we saw over the last week, we saw the reverse. Stock prices went down over the last week. The trends that I'm seeing here in 2023 is that first, bad news is severely hitting companies where, giving you an example, Lyft came out with a bad earnings report. It was a bad earnings report, but their stock got hit 36%. That was severe. Second example, Google had an AI showcase showing their artificial intelligence capabilities. And I don't think they hit a home run. But just by not being able to show that they're the leader in AI, their stock's down 12%. Now, I'm in the technology industry and understand artificial intelligence, AI. Now, AI is 10 years from being monetized. Might be a little sooner, but we're not sure how it's going to be monetized. We're not sure who's going to be the winner. And for a stock like Google to go down 12% just on the perceived notion that they're not going to keep up with AI, it was severe. So bad news is just hitting the market hard. And to me, that's because the market is nervous. Investors are nervous. They're not optimistic. They're not confident. They lack confidence and they're worried. Second trend, earnings have been low to okay. Some earnings have been deemed to be really positive because they weren't bad. And it's like, okay, that's very different than a couple of years ago when earnings were just exceptional. Companies were growing, they're very profitable, they're yielding great free cash, their balance sheets were in great shape. And in that era, good earnings reports are driving the market as they should. And nowadays, it's just, if you don't have too much bad news, that's a good report. And the last trend is interest rates are moving higher, as I showed in those charts. And those interest rates have a direct effect on stock prices. What do I expect for the rest of the year? The Federal Reserve is on a mission, and they're going to fight inflation. They're not going to let go of that fight in 2023. It's going to persist into 2024. So interest rates will go up 50 basis points this year, maybe a little higher. If they go, if the Fed announces they're going to go up 75 basis points in 2023, the stock market will be hit 5%, 10% to the downside. Right now, it's expecting a 50-point basis increase. And as you have that interest rate increase and it affects that weighted average cost of capital that you discount companies by, stock prices will trade down. At the same time, bonds will continue to get more and more attractive. Bond yields are looking really good, and they're going to continue to get better. So bond yields are really catching my attention as an investor, and they will be part of my plan in this coming week. S&P index, or I should say stocks in general, they're going to end up 5 to 10%, higher this year. And, that really is a low expectation. But that's a pretty, at the same time, optimistic expectation that they're not going to go down like they did last year. So that's my expectation for 2023. My plan, when stocks prices go down, it's good news. It's good news for somebody who wants to buy a great company and just own more shares. So I have a list of the companies that I want to buy, and I'm going to share that list with you. And when stock prices drop, I will buy more shares in those companies. I'm also going to buy more bonds. And I've bought both individual bonds as well as bonds in an ETF. I'm going to be buying into a Vanguard ETF, and I'm going to showcase the 3 Vanguard ETFs that I'm going to be investing into. Last, it's just I have to continue to study the market, study the companies I invest in, study bonds, and take what the market's willing to give me. It's not about trying to, time the market or outsmart the market. Is just really understand where are we, where are interest rates, where market conditions, are companies doing well? Do I expect companies to thrive? And then really buying into what I believe the market is presenting certain opportunities, and those are the opportunities I'm going to buy. Here are my top 10 stocks that I'm ready to buy this coming week. Starting off with Pangaea Logistics. This is a shipping company, very profitable, pays an awesome dividend, and continues to rise in value. Big Five is a discount retailer. They pay a great dividend, profitable, really good recession stock because they sell discount items in their stores. Airbnb, they will beat the recession because people that own homes can rent out rooms. So if they get laid off or if they have some adversity financially, they can make it up by renting part of their home. And it's a global business. Airbnb is thriving internationally. So they're going to beat this recession, and they're going to reward investors with a great return. CVS Healthcare always does well in recessions, and they pay a very nice dividend, have very good upside. Ally Financial, great dividend, great upside. ABBVIE Pharmaceutical does really well in recessions. They pay a great dividend. Zoom, the Zoom economy, where you work from home, where companies have to do a lot more with less employees. Zoom is the formula for companies to reduce their cost. I believe Zoom will thrive in this recession because employees and people will meet on Zoom instead of having to travel to meet each other. It's more efficient, and Zoom is here to stay. Dow, a materials a manufacturer, very well-run company, excellent balance sheet, great dividend, really good holding during this recession. United Airlines, travel, there's pent-up demand. So going into 2023, United is raising their ticket prices, increasing their profitability, increasing their free cash flow that they've generated. Great stock to own in 2023. And Ford Automotive, where Ford has a great lineup of cars. They pay a great dividend. They're profitable and a great stock to have in 2023 since there's so much pent-up demand for automobiles. So that's my top 10 list of stocks that I'm ready to buy this coming week. These are great companies. I want to own more shares of these companies. So if the market discounts these companies, I'm going to buy more shares. With interest rates rising so much, it makes bonds more attractive. For example, I'm buying into the Vanguard short-term bond ETF. As interest rates go up, the price of a bond goes down, and the yield that you make as an investor in that bond goes up. So this particular ETF has a very low risk profile, and the yield is 4.31%. So that's like owning a stock that has a 4.31% dividend, and the stock price is more stable. In this case here, there's very little risk of the actual bond changing value, or the bonds that they own changing value, because the term is so short. Moving on to an intermediate bond ETF. Intermediate meaning the bonds have a maturity date that is 4 to 7 years from it maturing. The yield is a little lower and the risk is a little higher. But as we see that interest rate yield curve change, right now it's inverted, you're going to see intermediate bonds rally, and the yield will continue to rise, and it will provide a very good yield. But again, 4.18% is a very good yield to get from a bond ETF. And the third ETF that I'm buying into is the Vanguard Long-Term Bond Fund ETF. And this ETF is of higher risk because the term is longer. These bonds that this ETF has have a maturity of 10 years or longer. So there's more things that could happen in those 10 years, like interest rates can go up even higher, which would drive the price of this bond ETF go down, but interest rates could also drop, and you could get a very good appreciation in the bond yield as well. But overall, over the last 30 days, this has yielded 4.55%, which is, again, a very good yield. Hey, thank you for watching the video. I really enjoy making the videos and contributing to the overall individual investor community on YouTube. I hope you found some interesting facts that I revealed over the past week, and appreciate the plan that I have going into the next week. Maybe it drives a couple of ideas for you as well. Good luck investing in 2023.